Let's do it, folks. Good morning, one and all. Welcome to the Streets Opening Bell here from Post 35 on the floor of the NYSE. Today is Wednesday, the 14th of September. I'm your host, JD Durkin. Opening bell rung here just a moment ago by American Assets Trust. That is ticker symbol AAT. This in celebration of 12 years as a public company. Congratulations to them. A quick check of the big board here just a few moments into this trading Tuesday. Obviously, the story, large in part, still continues to be yesterday's session. Trust me, we have plenty to cover where that's concerned. But as things stand right now across the indexes, we are up fractionally. That is true for the Dow, the NASDAQ, as well as the S&P. With regards to the Dow 30 right now, it does appear just a few moments into this trading session, the majority of those stocks are trading into the green. The gains are being led by Merck, Johnson & Johnson, and Chevron at this time. And taking a quick look here at the 11 sectors as well. We've got 4 of those 11 sectors currently in the red, the rest in the green, energy leading the way, as well as consumer discretionary. And again, no shortage of things to talk about. Let's take a look at what is on tap for this morning's show. We'll kick things off, of course, with an eye on the markets. And after yesterday's session, how could we not? We'll be talking the latest indications and what yesterday's session means for the Fed's big week coming up next week, plus the latest on the looming railroad strike. Huge story, and it's rapidly getting closer to it, and how the White House is getting involved. Plus new mortgage rates data and what it means to you. Of course, investors still reeling from yesterday's trading session. It was the worst day for major averages since June of 2020. The Dow fell 3.9%, S&P 4.3%, NASDAQ Composite more than 5%. All of those snapping a 4-day winning streak. All 30 stocks in the Dow finished lower, as did all 11 sectors in the S&P. Tech itself was a huge story in focus. The 6 largest tech companies lost more than $500 billion yesterday alone. All this after the August CPI report showed inflation rising, likely pointing to a more aggressive Fed at next week's meeting. And while it may not have been a great day to check your portfolio, it is good to get some perspective and a bit of context to everything that we are seeing, especially on a day when you see a lot of red here on the big board at the NYSE. And of course, what it all means for you. Luckily for all of us, we have our senior editor and markets correspondent, Martin Baccardax, to help take us down a little bit, maybe help us take a deep sigh and a pause in good faith, dare I say. Martin, good to have you here, and good morning to you, my friend. It's been about 24 hours or so since you and I last spoke. What are we looking at for today's session after yesterday's truly major sell-off?
It really was. And I think you laid out the context really well with respect to the fact that the market lost so much of that value in a 24-hour period. What was interesting to me was the fact that market volatility wasn't really that accelerated. And I think when you see stocks fall to such a degree, we're looking at declines that we haven't really seen since the beginning of the pandemic in 2020, and you're not seeing a corresponding increase in volatility measures. That's a cause for concern, because it does suggest that investors are taking a wholesale approach to revaluing equity performance rather than simply reacting to market functionality. Now, whether that turns out to be true going forward is another discussion, but yesterday did seem to be slightly more orderly because the volatility wasn't there, and that probably does suggest that people are retrenching rather than looking for bargains right now. And that seems to be being played out from what you were eliciting just a few moments ago, and that's the defensive sectors are on the rise as we open the trading day. So if we are seeing a retrenchment from investors rather than a reaction, they are absolutely going to pile money into cash-rich stocks to the more defensive categories such as energy, healthcare, banking, insurance, and things like that, and they're going to pull away from risk markets. So we may see more declines for the tech stocks as interest rates rise, and more declines in the riskier portions of the market as we see people pull back from their sort of bullish sentiments as a result of that inflation data that we saw yesterday.
Martin, I wonder to what degree you've been able to dig in here, because you're the busiest man I know, especially in the mornings, but we do have new producer price index information, and dare I say, it paints a little bit of a better picture than obviously what many people would say some calamitous data that we got yesterday. Any more clues to the state of things here, and what should people know if they're not otherwise tapped in to the producer price index figures?
Well, I think one of the great things that you can look at in producer price numbers, JD, is the difference between factory gate inflation and consumer price inflation, because it gives you an indication of whether or not companies can pass on their price increases to customers. If, in the case that we have now, producer prices are rising at a slower pace than consumer prices, That gives companies a bit of margin, and they can create profitability on the back of that. If those numbers get inverted, it becomes more difficult for companies to pass on price increases, and that, of course, has implications for profitability going forward. What we saw this morning, however, was even more interesting. Producer prices were a little bit tamer than we thought. They're running slower than consumer prices, and that's a good thing. But core consumer prices, core factory gate prices actually came in faster than anticipated. That might cement some of the concern that economists have that inflation dynamics are getting deeply embedded into the US economy and therefore will take a lot longer to unravel. If we go back to the inflation data yesterday, we saw that things like rents were one of the most significant components of the August increase. Rents are going to stay high because most people are going to get into multi-month and indeed multi-year contracts. That's really hard to unravel and likely means that we aren't going to see a corresponding decline for many months now. So I think part of the market reaction, again reflected today with the PPI data, was that inflation dynamics are now finding themselves wedged into the economy in a way that we didn't anticipate a few months ago. And indeed, the market was teed up for seeing them to fall away heading into these autumn months. But it's not doing that. And that makes the Fed's inflation fighting mandate that much more difficult. And of course, elicits a bigger change in the expectations for performance over the coming months and into the end of the year.
So let's go there to the Fed because we are 1 week out from September 21st. Martin, you and I and everyone here on the street, we've talked so long about will it be 50 or will it be 75 basis points? And suddenly after yesterday, here on the trading floor, we start to hear that there's nearly a 20% likelihood of 100 basis points. This morning, for the first time, I hear an indication of maybe 125. Something that maybe you came across it. I had not come across those figures from anyone I'd spoken with the last few weeks. Of course, you follow CME Group's Fed Watch very closely. From where you sit, admittedly, I'm in the cheap seats. You're down actually in the arena, my friend. Has the likelihood shifted from 75 basis points at all, even in the last day or so?
It absolutely has. I think 125 is still a pipe dream, but 100 now seems to be in play, at least from a trading perspective. From a functional and reality perspective, I stick to what I said yesterday. I really don't think it's a probability now. I think we have cemented a 75 basis point rate hike, but nonetheless, we're seeing interest rate futures suggest as much of a 33% chance of that 100 basis point rate hike next week. That would be the biggest since November of 1984. And really, we haven't seen increases of that size for the longest time, and probably for good reason, because they are dislocating to markets and they elicit more, dare I say, panic than assurance with respect to the Fed's inflation fight. If the Fed, which has been consistent in its rhetoric that it needs to see compelling evidence of slowing inflation first before it even begins to think about slowing down rate hikes, if it's going to be spooked by one report and then look to a 100 basis point increase, people are going to stop believing what they have to say about inflation altogether. So even if the Fed thinks that a 100 basis point rate hike is needed, they're very reluctant to go for it because of the market reaction that they're going to get and the indecision and the sort of the lack of confidence that market players are going to have with their inflation prospects going forward. So it does seem to me a bit of a stretch, but the fact that it's out there is enough of a conversation as to, and that's to sort of elicit these bets and to blunt any chance of the market rebounding from yesterday's significant sell-off.
I sit there having covered politics in Capitol Hill and the White House for so long, and I wonder in a moment like this what the administration sits there and says, well, clearly we need to get inflation under control, but if you're Joe Biden, if you're the Democrats, again, just strictly politically speaking, you want to avoid a lot of headlines the likes of which you had yesterday. These numbers get weaponized in bad faith. Not that nearly anyone in the political arena really gives it the proper business context. It's just a very fascinating and very delicate dance, of course. Martin, I do want to ask you specifically about tech stocks, if we can. They got hammered in the session to any degree that you can. Apple down 5.8% yesterday. Microsoft 5.5%, Alphabet 5.9%, Amazon 7%, Nvidia almost 9.5%. Is this to some degree overvalued names continuing to come back down to earth a little bit, or how do you read what we saw out of tech yesterday?
There's a couple of ways to read it, really. The most simplistic is the one that I always tend to go to, and that's something that we all learned back in sort of Finance 101, if you were unlucky enough as I was to study it, is something called the time value of money. Now, essentially, I'm going to put it to you this way, JD. If I were to offer you $1 tomorrow or $1 30 days from now, you're better off taking the dollar tomorrow because you can start making it work in terms of generating interest more quickly. Therefore, $1 paid in 30 days is worth less than one paid today. That's called the time value of money. I bring that up in the context of tech stocks because most of them promise earnings generation that's further down the road than traditional companies. Therefore, the earnings power has to be discounted by a higher interest rate, and therefore we see the decline in tech stock prices as a result. Now, what generally happens is that solid names such as Apple, which generates tons of cash, Nvidia, Microsoft, and all the others, get swept up in the repricing. They will tend to rebound more quickly than tech stocks, which are growth orientated and not those delivering earnings on an immediate basis. So it gives investors a chance to buy big names like Apple at a discount of 7, 8, 9%, which is
May have lost
very
Martin
often.
here.
But it
Martin,
does mean that
Martin,
the cheaper tech
my
stocks.
apologies. I'm going to cut you off for a second, Martin, for just a second. You cut out. If you wouldn't mind just going back
Sure.
a sentence or so. We briefly lost your feed, and I just wanted to make sure our viewers were caught up. We got you now, though. Thank you.
Oh, good. Where did we leave off, JD? I was so it was a bit of a soliloquy on tech stocks.
I think honestly we just missed that. Yeah, we just missed that last sentence or so before I stopped you.
Yeah. So essentially, yeah, the big names don't go on sale very often. They get swept up in the repricing as a result of the jump in interest rates. So it's the cheap. It's sort of the tech stocks that are more growth orientated that tend to suffer the most. So if you are someone who's looking at the big names, don't assume that simply because they drew back so quickly that that's going to last into the future.
All right, thank you, and thank you for your patience there, Martin, for letting me interrupt you. I hope you don't mind. That has never happened, so I got you. Okay, so don't look now here, but we are inching closer. Yeah, of course. Listen, it's the beauty of live TV. You can invariably count on something going wrong. Listen, don't look now here to viewers at home. We're inching closer to what may be truly the first major railroad strike in 30 years. What a story, Martin, that really has come to the forefront the last few weeks, months, but really here the last couple of days. This for an already hobbled supply chain. Could this spell disaster to some degree? And what components of this, economically speaking, are you most closely following as we get closer to Friday at midnight?
Well, I think the timing is terrible for the administration, largely because I think the most significant impact of this strike, if it were to go ahead, would be on prices and, of course, the stoking inflation that we're already seeing inside the economy. It's the last thing the administration needs going into the midterms, and they certainly don't need a labor dispute as well. But ultimately, whilst I don't think this is going to be the economic disaster that some are predicting, there's no doubt of its seriousness. We're talking about 60,000 unionized employees working largely in the freight rail sector, which still haven't agreed to terms to a new labor contract. Now, that's as a result of disputes over working conditions, pay, absentees, and all these other things. But ultimately, that's going to have to be brokered in part by the White House, Transportation Secretary, and the Labor Secretary. So there's a lot of moving parts into getting a deal. Now, it's worth remembering that the administration has already come to a tentative agreement with about 115,000 employees already. So maybe this might just be a case of timing in order to get the other 60,000 on board. But because the clock is ticking, and if there isn't a labor agreement agreed by midnight on Friday, the strike could begin. People are now starting to calculate exactly what the economic damage might be. There are expectations that it could cost the economy about $2 billion a day. The freight workers that would go on strike would be responsible for moving about 30 billion worth of goods on any given day. And of course, there would be spillover implications for passenger rail networks as well, because they share the tracks. So there's a lot at stake with the result of this. I get the sense that there's probably going to be at least a tentative agreement, and maybe we might kick the can down the road a couple of months as a result, or at least past the midterms. If the administration were smart, they would try to do it that way in order to avoid that kind of disruption. But the fact that these delays could happen certainly doesn't give investors any more confidence about slowing inflation, because delays in prices and more supply chain disruption is only going to mean higher inflation rates in the coming months.
I want to talk a little bit more about what we've seen from the White House, because this includes what at least appears to be very active involvement, not just from Labor Secretary Marty Walsh, not just by leading administration officials, but even President Joe Biden himself. And this is a guy that ran for the White House largely on the back of union support. And this, unsurprisingly to me, is the sort of story that the president would try and roll up his sleeves and at least make some phone calls. And reports and all indications have shown that he has been doing that. What do we know else about how the administration specifically is trying to relieve tension here in the next crucial few days?
Yeah, they're doing a lot of jawboning with respect to that, JD. They're talking about tapping sort of excess capacity in air freight and in truck transport as well. But really, that's not going to pick up the slack with respect to the implications for this strike, because there's just too many goods that are already destined for their ultimate ports as a result of being moved by rail. And of course, if there is a strike, they're not going to be moved. They can't easily be then transported into trucks and planes in order to get to their final destination. So what the administration is saying, I think, is meant to alleviate immediate concern, but it's not going to have much of a practical difference in what we're seeing. Your point is a good one, though, with respect to President Biden's sort of association with the union movement writ large. And he has been involved in this, although he has been more behind the scenes than certainly I anticipated. That might change today if the meeting between Marty Walsh, the Labor Secretary, and the union leaders doesn't go well. The president could sort of sweep in at the 11th hour and try to broker a deal between all of the concerned parties. But at the moment, he seems to be happy to delegate it, at least to some degree, to his cabinet members. But again, we'll have to watch over the next 24 hours, because no one wants this to come down to the final minutes, certainly at least not the president himself.
There's also a lot of chatter here, Martin, about Congress acting, although I do want to caution that Senator Dick Durbin said it within the last day. His quote is, "I don't think it's likely we will intervene. It depends on the parties in negotiation stepping up to the plate." Oftentimes, I mean, look, we're within 60 days here of a midterm election. I don't think Congress wants to do a heck of a whole lot other than be at home campaigning, raising money, and keeping job security. This is a very messy situation for Congress to get in, even if we weren't 2 months out from a midterm election. Talk to me a bit more about the potential economic impact, and then anything there on the congressional point that I brought up, and what that could look like if both parties decide to say, you know what, let's put aside our differences in this crucial midterm election season and actually try and get something done. I know you say it out loud and you can't help but laugh, but what are we looking at?
There's absolutely no way that I can see that a Republican lawmaker would gift a Democratic rival the kind of the kind of support that would be required for a congressional movement to make sure that we don't get a strike on Friday. The best thing a Republican could do at this stage would be to sit back, let it all happen, and then if there is a strike, they could tag their rivals in the midterms as being so soft on unions that they allowed a strike to go on and therefore accelerated the inflation pressures and put the economy at risk. That would be absolute catnip for the base and would absolutely be the kind of thing that a Democratic lawmaker is not going to want to run against when they go on the stump in October. So I'll be terribly surprised if it gets to the congressional level, which is why I think we're probably going to get some kind of tentative agreement at the executive and administration level over the next 24 to 48 hours, because there's just too much at risk from a political perspective.
Martin, I want to give this a bit of context for a viewer who may be watching to say, not to be crass about it, but someone may be watching and say, why does this matter to me? I don't work in the railroad industry myself. My loved ones don't work in the, what do I care? Someone could say, I'm hypothetical. What does it matter to me? What does this mean for an average American consumer who may otherwise think that he or she might be outside of the impact zone of a potential labor strike like this as it pertains to something as important as the railroads? Because whether we realize it or not, this impacts every single one of us, doesn't it?
There's no question about it. I mean, the most key components in building pretty much anything in the U.S. economy are moved by rail, whether it comes to chemicals, whether it comes to energy, whether it comes to lumber, bricks, concrete, you name it. It's by and large transported by the freight railway sector, let alone the discussion about what would happen to goods and services and UPS packages and FedEx packages and our Amazon deliveries and everything else like that. The freight rail sector is absolutely and unequivocally critical for U.S. growth. And the implications are that even a single-day strike could cost the economy $2 billion. Multiple-day strikes would probably increase that number going forward. And we're talking about $30 billion in freight rail goods that are moved on any given day. So this is not small beer, and it certainly would have the kind of spillover implications that would exacerbate the supply chain disruptions that we're already seeing as a result of the pandemic. Now, a lot of those have become unstuck, thankfully, but we only need to look back to the few days that the ship, the Evergrande, if I have the name at the top of my head in memory, was stuck in the Suez Canal. The spillover delay in supply chains there was significant and highly disruptive, and it was certainly a cause for inflation increases in the months that followed. We could see something similar here in the United States with a prolonged strike, so there's absolutely significant economic implications at play. But again, I really do believe that we're going to get some kind of tentative agreement over the next 48 hours, or at least one has to hope.
Martin, this is not the most important question that I'm going to ask you on a crucial markets day like today. However, my friend, there was an interesting idiom that you used in your last response. I admit I've never heard of the phrase small beer, but I know it's a thing because I Googled it. I'm just on the outside. Could you mind enlightening me what the usage of the phrase small beer? Because I would very much like to use that in my day-to-day.
Yes, I guess it's an old British phrase, isn't it? Now that I think of it, but essentially it means it's nothing to be. What would an American say? It's nothing to be sniffed at. It's nothing to sneeze about. Is that would that be the similar expression? Yeah, I think so.
Nothing to sneeze at. Yeah, sure.
There we are. Yeah, there we go. Small beer, nothing to sneeze at. There we go. Yeah.
I like that. We might start calling the show just Small Beer Markets with
Small
Martin.
Beer would be a great name for a podcast, wouldn't it? Yeah.
Small Beer would be a great name for a podcast. Again, thank you for letting me ask that because I heard you say it with such conviction, and I said, they say learn something new every day, right? That's the thing. You wake up, learn something new. You and I need to trademark
this, JD, the Small Beer podcast. Yeah, absolutely.
Well, see, this is good because I'm from Jersey, so I've got my own Jersey idioms. Oftentimes, they're not appropriate to say on air because that's how it is when you're born and raised in New Jersey. But I do like the phrase small beer, and I'll try and use that into our as many shows as possible. All right, let's get on here with something else that's very important, and this is new mortgage data. And this is the demand for mortgage applications has gone down. This, of course, as interest rates continue to go up. We're covering the Fed very closely on the 21st. What did we learn, Martin, from the Mortgage Bankers Association, and what does this also mean for someone who may be watching at home?
Yeah, this one's key. We've gone over 6% on a confirming 30-year fixed mortgage for the first time since 2008. That's according to the MBA. It's essentially a lobby group for the mortgage industry writ large. Essentially, we're up 7 basis points from last week, and we're up from about 3.5% at the beginning of the year. So that's a significant increase in borrowing costs. It's probably for, again, the most conforming, the most secure of all mortgages is now at 6.01%. So there's going to be corresponding increases for those with slightly weaker borrowing mechanics or credit scores and things like that. But this is the baseline. And the fact that we are at these high levels indicates probably more headwinds for the U.S. housing market going forward. And that's not necessarily good news because the housing market is already facing just a host of disruptions with respect to a lack of new supply, the fact that we're not getting people putting their housing on the market in terms of existing home sales. Of course, there's the expectation of faster rate hikes, and that's only going to increase mortgage costs as a result. And of course, when that happens and the economy slows, banks tend to rein in their lending sort of requirements, and therefore it becomes more difficult for even good borrowers to get the amount of money that they need in a new mortgage application. So it becomes a bit of a downward spiral when we see these things hike up to these levels. We're nowhere near the concern with respect to housing bubble risk that we were in 2008. And that's largely because of a lot of sort of stopgaps that were put into place after the global financial crisis. The Fed is incredibly vigilant with respect to the risks that banks take on, not only in mortgage lending, but virtually everything else. There has been a great deal of purchases of mortgage-backed securities by the Fed over the past 10 years. They're unwinding that a little bit right now, but there's still a backstop in a crucial market. And the lending component the lending sort of structures that banks are working on today are quite different than they were prior to the housing crisis in 2008. So they're not necessarily comparable, but that won't be great comfort to someone who's going out into the marketplace right now to look for a house, because prices are still elevated, but mortgage costs are still rising. That's not a good mix for anybody who wants to buy, and not great for anybody who wants to sell. It has to be said either.
I like the context of an answer like that, Martin, because oftentimes when you and I do this broadcast, we talk so much about what has been done and stopgap measures and guardrails on the system because of the era of COVID. This is a story that goes back further, right? This predates COVID, some of these guardrails on the system, back to the financial crisis. That's really important context there that I appreciate, because obviously we get so focused here on a short-term memory of the last 2 to 3 years, rightfully so. But a story like this has implications that go back to 08 and 09. So I do appreciate that. Finally on this, you were briefly hitting on this, but a bit more if you can. How does this further shape what Mr. Powell and his colleagues will be considering next week, if at all?
Well, here's the thing. He has said on a couple of different occasions, and it was highlighted during his speech in Jackson Hole, Wyoming last month, that taming inflation and sort of engineering that soft landing that the Fed is aiming for is going to cause a lot of pain. He was pretty, he was as transparent about the fact that this isn't going to be an easy task and that people are going to have to pay a price along the way. And actually, the housing market was part of the economy that he sort of singled out as being likely to experience more rather than less as a result of the interest rate increases and the slowdown in the economy. So I don't know that this is necessarily going to knock him off his path, but it does remind us that we should be paying attention to what the Fed chairman has to say on a consistent basis, because he has repeated these messages, and whether or not they've been heeded by market participants is another thing. What's good, if there's good to be found, is that we can sort of trust the messaging from the Fed in its consistency, because he has said and has warned about the pain in the housing market for a number of months now. What's bad, of course, is that he isn't going to be sort of knocked off course as a result of what he's seeing. And that is probably, again, not the best news for people who are participating in the housing market, either as a buyer or a seller or indeed a lender.
All right, Martin, thank you. That was a lot of topics that we just got through, and we still have a few more because it's time now for our morning rapid fire section. Pew, 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 pew. Okay, let's do it. First up, shares of this company, by the way, are popping on the day. SBUX, it's up 4.7%. First question, what did we learn from Starbucks' big, highly anticipated Investors Day, Martin?
Yeah, this is interesting, and I'm actually surprised that the stock is up as much as it is in a day where we're finding it difficult to rebound. But they had a big boost in their near-term growth prospects. They see earnings rising between 15 and 20% over the next 3 years, and that's about that's a big jump from the 12 to 15 that they had forecast only last year. They're going to open a lot more U.S. stores. They're going to double the amount of stores they have in China, and they're going to invest around $3 billion in store renovations and in technology. And I think this is the interesting one to me, JD. They really want to make sure that they can continue to capture and grow the increase in digital sales. Right now, digital sales for Starbucks comprise around a quarter of all of their revenues, and that's an enormous increase from only 2 or 3 years ago, and it represents the change that is the result of sort of a pandemic dining, if you will. We're just not as comfortable, for whatever reason might be, to sit inside the dining rooms of places like McDonald's and Starbucks and others. Maybe it's because we're working from home. Maybe it's because we're not traveling to the office in the way that we were, and therefore we don't need those 15-minute breaks in the middle of the day. But for whatever reason it might be, we're definitely buying more things online, and that necessitates bigger investment from Starbucks. What seems to me, from the investor point of view, to be taking place right now is that investors are not worried that these increased investments are going to narrow profit margins in any significant way. That's good news for Starbucks. What might also be in play today, JD, is that they hinted that they're probably going to start returning to share buybacks in their coming fiscal year and then going forward. Howard Schultz suspended those earlier this year as they sort of retooled and tried to repair relations with their employee base. So important and a big move for the stock today.
Well, another company that is having movement in its stock, though it's heading the other direction right now, are shares of Twitter, down 0.9 here on the floor. which leads us to our second question. Twitter shareholders voted to approve the Elon Musk sale, which is like the least surprising thing. Of course they did. Martin, what happens now?
The only surprising thing that wasn't 100%, it was only about 98.9. So I do wonder whether Elon Musk was in the ear of some of the people that decided to vote no. But essentially, yes, this was a fait accompli, and it really just is the next step in the process, if you will. Twitter says that it has cleared all of the hurdles from its perspective in order to compel Elon Musk to follow through on his $44 billion takeover pledge, which he unveiled in the spring. Musk, of course, continues to say that he's not going to buy the company, that there are too many questions with respect to its underlying metrics on the calculation of fake accounts, and indeed whistleblower allegations with regards to Twitter's alleged lack of security just reinforces his concern. What's interesting, of course, is that when he said he wanted to buy the company, he wasn't concerned about the economics. He was only concerned about his sort of stature in American life as a free speech absolutist. We can debate that one ad infinitum, but nonetheless, it does put himself in a precarious position heading into October, because if he doesn't care about the economics, then what is underneath the hood of the company he buys shouldn't matter either. Whether the judge holds him to that or not is another story, but we're heading into October now with clear eyes as to what is at stake here, and that's a lot of money and probably one of the most controversial social media companies out there.
Absolutely. Finally, let's talk Google. What did this company do to deserve a $4 billion fine, Martin?
$8 billion in collective fines, actually, JD, over the past 10 years as a result of the competition authorities' crackdown on big U.S. tech companies. Basically, this is a fine from a couple of years ago that has been in the appeal process. The second highest court in Europe essentially upheld it today. It's going to be about $4 billion US dollars. The allegation is that Google basically used its muscle on Android phone manufacturers to ensure that Google's search dominance remained inside the world's biggest economic bloc, and indeed in other parts of the world economy as well. Margaret Vestager is the competition authority in Europe, and she has had her sights trained on U.S. tech companies for a number of years now. So the precedent is firmly set. There's one more appeal that could be made, and that's to the highest court in Europe. That might take another year or so to filter through. But it does suggest, and certainly if that's upheld, it would cement the fact that big tech companies are not going to be able to do exactly what they want in markets all over the world if the EU has anything to do with it. And therefore, these fines are only going to increase probably in frequency and certainly in value.
Martin, I'm consistently amazed at the ease with which you can handle any and every market, investing, and quite frankly, sports topics as well. We'll have football and things to talk about tomorrow. Martin, I'm very appreciative of your time.
Indeed.
The great Martin Baccardax. Thank you for taking the time to join us here
Thanks,
on this
JD.
Wednesday morning. And my friends, that is going to do it for Opening Bell here from the floor of the New York Stock Exchange. Stick with TheStreet.com for more on these and every other major market story that mattered to you. We'll see you later.